Hola, muy buenas. A continuación leeré el siguiente artículo en inglés. Al finalizar el artículo, diré pues las conclusiones de este artículo, de qué trata más o menos el artículo en español y cómo este tema se va relacionando con los artículos que he estado leyendo y pues más que todo la temática en la que me centro es el manejo de riesgo y esto cómo se involucra con la IA y las fintech. Bueno, daré inicio. Research on the impact of corporate financialization on debt financing level from the dual perspective of risk taking and earning management. Okay, abstract. This study investigates the impact of corporate financialization on firms' debt financing decisions using a panel dataset of Chinese A-share listed companies from 2007 to 2023, employing firms and year-fixed effects regression models. We find that higher financial asset holdings are significantly associated with lower levels of debt financing. Robustness is ensured through various tests, including linked variable models, propensity score matching, the Heckman two-step correction, and alternative fixed effect specifications. Mechanisms analysis reveals that financialization reduces debt usage by increasing firms' risk-taking behaviors and decreasing earnings management. Moreover, heterogeneity analysis shows that the effect is more pronounced among state-owned enterprises and firms receiving higher levels of external monitoring, such as such as analyzed coverage. These findings suggest that financialization not only alters firms' financial structures but also reshapes internal governance and risks preference. Okay, introduction. Over the past several decades, corporate financialization, the increasing integration of financial activities and markets into the core strategies of firms to generate profits, has emerged as an outstanding characteristic of modern economic systems. This phenomenon, involving a shift from traditional business operations to financial activities, has influenced how firms make decisions and allocate resources. While financialization has provided firms with opportunities to diversify revenue streams, optimize capital allocation, and enhance shareholder value through mechanisms such as stock buybacks, dividend payouts, and speculative investment, it has also raised profound concern about its broader societal and economic implications. These trends undermines the real economy's foundational role, create, creates a structural imbalance with the virtual economic and raises systematic economic risk. Capital structure refers to the proportional compositions of a firm's sources of financing. It is a key indicator of financial health and plays a significant role in determining firms' value a firm's capital structure is influenced not only by external financing constraints, but also by the strategic decisions made by its management. Public sector economic activities, bank credit availability, and macroeconomic conditions all exert important influence on capital structure. Adjustments to capital structure are often managerial responses to changes in the external environment. Understanding how corporate financialization affects firms' debt level is of significant theoretical and practical relevance. On the one hand, financialization alters firms' asset structures, cash flow patterns, and risk preference, which may directly influence their financing behavior and capital structure decisions. On the other hand, with the deepening integration of financial and real sectors, excessive financialization may distort the optimal balance between equity and debt financing, potentially increasing financial fragility. Therefore, examining examining the relationship between financialization and debt levels helps to clarify the transmission mechanisms of financial behavior on firm level financial stability and provides important implications for corporate governance and macroeconomic regulation. This study examines the impact of financialization on corporate capital structure decisions. Using a large sample of Chinese listed firms, specifically, we investigate how the allocation of financial assets affects firms' reliance on debt financing. The baseline regressions results show that a higher level of financialization significantly reduces corporate debt levels. This finding remains robust after a series of sensitive tests, including lagged explanatory variables, propensity score matching, PSM. The Heckman two-step model first differences estimations, enhance fixed effects, and the exclusion of extreme macroeconomic periods. Mechanisms analysis reveals that financialization affects debt financing through two key channels: risk taking and earning management. Firms with higher financial asset holdings tend to exhibit greater profit volatility, lower earning manipulation, and lower earning manipulation, both of which are associated with reduced use of debt. Heterogeneity analysis further shows that the negative impact of financialization is more pronounced among state-owned enterprises (SOEs) and firms with higher levels of analyzed attention, highlighting the moderation roles of ownership structure and external monitoring. Overall, the findings suggest that financialization not only influences firms' resources allocation decisions but also shapes their internal governance and risk profiles, thereby altering their capital structure. The study contributes to the growing literature on financialization by providing new evidence from an emerging market context and offer insights for policy markers concerned with balancing financial flexibility
and sustainable corporate financing. The structure of the remainder of this paper is as follows. Section 2 reviews the relevant literature, summarizes the research progress on corporate financialization and debt levels, and clarifies the research position and marginal contribution of this study. Section 3 outlines the research design, including variable definitions, model specification, and data sources. Section 4 presents the empirical results, analyzing the impact of corporate financialization on firms' debt levels, along with robustness checks. Section 5 conducts further analysis. The final section concludes with a summary of the main findings and offer policy recommendations. Okay, section 2, literature review and hypothesis development. The impact of corporate financialization of debt financing. For non-financial companies, increased investment in financial assets tends to reduce investment in real assets. The high returns associated with financial assets may lead management to shift their investment preference. Alternatively, short-term financial assets can serve as a liquidity buffers, allowing firms to mitigate financial distress and maintain real sector investments. Moreover, rising financial assets prices can strengthen corporate balance sheets, ease refinancing constraints, and promote real investment by enhancing firms' financial health. Using a sample of U.S. non-financial firms demonstrate that firms increase their holdings of financial assets when they have surplus funds, aiming to improve capital utilization efficiency. This supports the view that precautionary motives contribute to the financialization of real sector firms. Conversely, corporate financialization may increase economic risk. Auto-industrial financialization increases stock dividends and facilitates speculative capital accumulation. The funds it relies on stem from financial resources allocation rather than growth in operating profits. This only fails to correct the misallocation of financial resources, but may also undermine the financial environment of the real economy. When real sector firms allocate a large proportion of high-risk financial assets and exhibit significant fluctuations in their holding over time, they are more vulnerable to external shocks and face greater financial risk. In practice, the target capital structure is a dynamic estimate, constantly optimized through the firm's ongoing interaction with its environment. A firm's optimal dynamic capital structure depends on the benefits and potential costs of debt financing, the availability of underlying assets, the risk-free interest rate, and the cost of capital restructuring. More recent studies suggest that capital structure choices are intricately linked to executive characteristics, the structure of corporate governance, financial architecture, firm-level features, and the business environment. Section 2.2 Hypothetical Development. With the increasing trend of corporate financialization, firms are allocating more resources to financial assets, while the real effects of this shift have sparked considerable academic debate. One important channel lies in its potential to alleviate financing constraints. Holding financial assets can serve as a liquidity reserve for firms, specifically in environments with imperfect capital markets. These assets can be liquidated quickly in times of need, allowing firms to respond to investment opportunities or mitigate cash flows shortfalls without resorting to external financing. In this sense, financialization enhances internal cash flow flexibility and strengthens firms' self-financing capacity from the perspective of capital structure theory, particularly the pecking order theory. Firms tend to prefer internal financing over external source due to the cost of information asymmetry and potential agency problems. Therefore, when firms hold a higher proportion of financial assets, the reliance on external debt financing is expected to decline. Moreover, financial assets can reduce the risk of financial distress, acting as a buffer that improves creditworthiness and reduces the necessity for precautionary debt accumulation. As a result, the firm's overall debt level may be lowered. To enhance conceptual clarity, we outline the theoretical pathway through which corporate financialization is hypothesized to influence firms. Capital structure. Step 1. Financialization. Firms increase their allocation to financial assets, leading to change in internal resources availability and risk posture. Step 2. Increase liquidity. Holding financial assets improve internal cash flow flexibility, thereby reducing the need for external financing in the form of debt. Step 2. B. Heightened risk-taking. Firms with higher financial asset exposure tend to pursue riskier strategies, which may raise credit risk and reduce borrowing capacity. Step 3. Reduce debt financing. As a result of both enhanced liquidity and greater risk, firms are less reliant on debt, leading to a lower debt ratio. Based on this reasoning, we propose the following hypothesis. Hypothesis. Corporate financialization reduces firms' reliance on debt finance. Model 3, 3.1 data. This study employs a panel dataset of A-share listed firms in China from 2007 to 2023 to ensure the validity and consistency of the data. The sample is restricted to non-financial firms, including the following. First, financial institutions such as banks, insurance companies, and security firms due to their distinct regulatory environments and financial structures. Two, firms designed as ST or ST, which are subject to special treatment due to abnormal financial conditions, and three, observations with significant missing values or extreme outliers. The financial and accounting data are obtained from the China stock market and accounting research database. 3.2 model to examine the effect of financialization on corporate capital structure. We construct the following baseline regression model. Debt fin equals alpha beta fin range. Okay, this is a formula where debt fin it is the dependent variable representing the debt financial level on firms. In year T, we measure the level as the ratio of the sum of long-term and short-term borrowing to total assets fin ratio, the key explanatory variable, measured as the ratio of financial assets. Is a vector of control variables, including firm size, profitability, ROA, cash flow, fixed asset ratio, growth rate, ownership, concentration, listing A, and managerial shareholding. Denote firm fixed effects to control foreign certain firms specific heterogeneity, denotes years fixed effects to account for macroeconomic and time specific factors is the error term. This model allows us to isolate the impact of financialization on corporate debt levels while accounting for firm level characteristics and time terms. Presents the definition and description of all variables used in the analysis. While fin ratio, defined as the ratio of financial assets to total assets, is widely used proxy for corporate financialization in existing literature. We acknowledge that it aggregates various types of financial assets without distinguishing their purpose or liquidity characteristic. For example, short-term tradable assets may be driven by working capital management or liquidity buffering motives, whereas long-term holdings may reflect speculative or investment-driven financialization strategies due to data limitations in disaggregating financial assets components across all firms and years in the sample. We use the overall financial asset rate to ensure consistency and comparability. Nevertheless, potential sectoral difference and heterogeneity in asset composition may influence the interpretation of fin ratio. We recognize this as a limitation and suggest that future studies could refine the measurement by incorporating asset maturity or tradability dimensions provided more granular data are available. We include a set of firm level control variables based on established literature to account for other factors that may influence corporate debt financing. Firm size measured as the natural logarithm of total assets. This variable captures the scale of operation and reflects a firm's access to external financing and economies of scale. Profitability (ROA). Return on assets serves as a proxy for internal financing capacity. More profitable firms may rely less on them due to sufficient internal funds. Cash flow represents operational liquidity and indicates the firm's ability to service debt obligations without relying on external sources. Fixed asset ratio indicates asset tangibility, which can be used as a collateral. Higher fixed assets ratio may increase firms' borrowing capacity. Growth rate, measured by the growth rate of operating income. These variables reflect investment opportunities and the potential need for external financing. Ownership concentration. The shareholding ratio of the largest shareholder reflects control rights and monitoring intensity, potentially affecting capital structure decisions. Firm age. Older firms may have more stable credit histories and easier access to debt markets. Managerial ownership reflects the alignment of interest between managers and shareholders, which may influence risks, preference, and financial decisions. 4. Results. Statistical summary. Statistical description of the variables used in the paper is shown in Table 2. The depend variable, the fin, which measures their financing, has a mean of 0.014 and a standard deviation of 0.016, 0.016 0.066 with values ranging from minus 0.232 to 0.327, indicating considerable variations in firms' use of debt financing. Firm ratio, representing the ratio of financial assets, has an average of 0.081, suggesting that financial assets account for 8.1% of total assets on average. The variable also exhibits notable dispersion, with a maximum value of 0.627. Fixed, measuring the proportion of fixed assets, has a mean of 0.212, with a wide range from 0.002 to 0.765, indicating large heterogeneity in asset structure across firms. Benchmark regression results. The report the results of the baseline regressions where the dependent variable is the fin column 1 includes only the core explanatory variable fin ratio, while column 2 adds a full set of control variables. Both regressions control for fin fixed effects and year fixed effects. Fin ratio is significantly negatively associated with debt financing across both specifications. In Model 1, the coefficient is minus 0.024 and it remains negative and statistically significant in Model 2 with a reduced magnitude of minus 0.018. The empirical results indicate that an increase in the level of financialization as measured by the fin ratio is significantly associated with a reduction in corporate debt financing. In addition to the main explanatory variable, several control variables also show significant association with debt financing, offering valuable insight. Size, the positive and significant coefficient on firm size suggests that larger firms tend to rely more on debt financing. This is consistent with the view that large firms face lower information asymmetry and enjoy greater access to credit markets. Cash flow. The negative coefficient on cash flow indicates that firms with a stronger internal liquidity are less dependent on debt. This supports the pecking order theory, which posits a preference for internal over external financing. Top 1. The positive relationship between top 1 and the financing implies that firms with more concentrated ownership may be more willing or able to take on debt, possibly due to stronger governance or control incentives that reassures creditors. Financial assets can serve as a liquid buffer, offering firms greater flexibility and reducing their dependence on potential costly or constrained borrowing. Firms holding a higher proportion of financial assets may rely more heavily on internal financial resources to support daily operation and long-term investment, thereby diminishing the need to access external debt markets. A higher level of financial asset allocation enhances a firm's liquidity position, which is particularly valuable in environments characterized by credit friction or heightened financial uncertainty. This increased internal cash availability allows firms to meet short-term obligations and respond to investment opportunities more efficiently without incurring the cost or risk associated with debt financing. This logic aligns with the pecking order theory, which suggests that firms prefer internal financing first, followed by debt, and then equity due to concerns about information asymmetry and issuance cost. From the perspective financialization improves firm financial autonomy. by reinforcing their internal capital base. Moreover, financial assets offer flexibility for risk management, acting as a precautionary reserves that can be mobilized during periods of external shocks or earning volatility. As the marginality of additional debt decreases in the presence of sufficient internal liquidity, firms may become more conservative in their use of leverage. In summary, financialization reduces corporate reliance on debt by enhancing internal funding capacity, improving liquidity for both operational and precautionary purpose, and lowering the attractiveness of necessity of borrowing from external sources. Ok, acá tenemos más análisis, further analysis. Conclusions and policy recommendations. Okay, conclusions. This study investigates the impact of financialization on corporate capital structure, with a focus on how firms' financial asset holdings influence their debt financing behavior. Using a large panel dataset of Chinese listed firms, we find robust evidence that higher levels of financialization are associated with significantly lower levels of debt financing. The baseline regression results show that the ratio of financial assets has a significantly negative effect on corporate debt levels, suggesting a substitution relationship between internal financial reserves and external debt. To uncover the underlying mechanisms, we explore two potential transmission channels, risk-taking and earning management. The results indicate that financialization increases firms' risk-taking behavior while reducing their engagement in earning management. Both channels are shown to partially mediate the relationship between financialization and debt financing, suggesting that financialization affects not only firms' resource allocation but also their managerial behavior and financial reporting practices. Furthermore, the heterogeneity analysis reveals that the negative effect of financialization on debt financing is more pronounced among state-owned enterprises and firms with high levels of analysis coverage. This indicates that ownership structure and external monitoring play important roles in shaping the financial decisions of firms under financialization. And some recommendations. The findings of this study have several important policy implications. First, given that the negative impact of financialization of debt financing is more significant among state-owned enterprises, policymakers should consider strengthening asset supervision frameworks and implementing financial governance reforms tailored to SOEs, enhancing internal control and clarifying the boundaries of financial asset allocation can help ensure that financialization supports strategic objectives without compromising capital structure stability. Okay. Bueno, a continuación diré pues como de qué trató el texto y la conclusión. Ok. Eh, este estudio más que todo habla de la financiarización. ¿Qué viene siendo esto? La tendencia de los activos financieros por parte pues, de las empresas, cómo impactan en su estructura de capital. Para ser más específicos, acá se habla del nivel de endeudamiento, que según el estudio que se realizó, encontraron una relación pues negativa e importante a medida que las empresas, esto se hizo fue en empresas chinas, que las empresas chinas que estaban listadas aumentan sus activos financieros y que reducen su dependencia de la deuda externa. Que esto viene siendo que las empresas utilizan sus propios recursos financieros provenientes de las inversiones en activos como sustituto del financiamiento externo. Y también en la investigación, pues profundizaron en los mecanismos de identificación de la financiarización, que viene siendo el comportamiento gerencial de las empresas y cómo aumenta su, ¿cómo decirlo? Como el riesgo que ellos toman y también cómo disminuye su propensión a la gestión de beneficios. Mejor dicho, al manipular sus reportes financieros, se sugiere pues desde el estudio de este artículo que la financiarización no solo modifica la asignación de recursos, sino que también influye en las prácticas de gestión y la transparencia financiera. Como se dijo pues desde el inicio, que la financiarización impacta en la estructura de capital de las empresas. Bueno, los temas que más que todo me he estado yo centrando viene siendo la inteligencia artificial y el manejo de riesgo. Acá con la financiarización, el endeudamiento pues se ve que hay una mayor cobertura en el análisis financiero, cambiando la estructura de la propiedad y el monitoreo externo, ya que se busca que por los recursos propios no se busque eh, como, ¿cómo decirlo? Como depender de recursos externos. Y esto tiene grandes implicaciones cuando se habla, por ejemplo, de la inteligencia artificial o del manejo de riesgo en el sector fintech, ya que la IA puede analizar pues más eficiente, de manera más eficiente y grandes volúmenes de datos financieros para identificar, por ejemplo, en este caso, patrones de financiarización y cómo esto impacta en la deuda, superando obviamente los impactos del análisis manual. Y los algoritmos de aprendizaje autónomos, pues la IA podrían predecir el comportamiento de endeudamiento de las empresas en función de sus carteras. También en cuanto al respecto a manejo de riesgos, la IA puede desarrollar modelos predictivos más sofisticados para evaluar dichos riesgos crediticios. Y en cuanto al sector fintech, estos hallazgos son cruciales más que todo para las plataformas de créditos basadas en tecnología. Pueden usar la IA para ofrecer evaluaciones de riesgo más precisas y soluciones de financiamiento más personalizadas. Esto logrando adaptarse al comportamiento de las empresas que se financian a través de inversión de activos en lugar de la deuda tradicional, permitiendo diseñar productos financieros que se alineen con las nuevas estrategias de capital de las empresas. Esto sería todo por concluir el tema que estoy investigando. Muchas gracias por su atención.